Hello traders and investors. The confirmation and setup I was looking for to put on an aggressive bullish trade did not happen. However, I did get the setup for the downside of failed support. In this video, I will go over some of the trades I took during and after this failed support. I'll cover what didn't work and what did. I will also provide my insight on how I plan to trade the next week based on the most recent price action. Since the major indexes generally move in the same direction, I will use the Semiconductor Index, SOXX, to review the market. Before I cover my technical analysis of the current price action, let's look at some of my trades last week. Like many traders, I bought right into the support level of this wedge or triangle. At this moment, I felt an ominous suspicion of a greater risk to the downside. I had too much exposure with swing trades in the short-term account. I had adjusted stops on all my swing SPAC trades with the understanding that a failed support on the indexes would spell trouble for most equities. Murphy's Law kicked in, and as I was watching a bounce set up in my favor, the news-based computer trading algorithm systems must have picked up the negative stance the GOP had taken against the stimulus package. Then I saw all my swing stops along with my day trade get taken. In a span of 1 hour, I took a 12% loss to my account. This wiped away 60% of last month's gains. Rookie mistake to say the least. Luckily, I had planned for what action to take if the support level failed and immediately switched to a bearish bias and began working on my recovery plan. Since I am on a cash account, I used SOXS to time the drop to the next support level on my 5-minute chart. With these subsequent trades and setups, I made a stand to make my money back. As traders, we are sometimes humbled by the market, but it is our resilience in the face of adversity that defines us and where we learn our most valuable lessons. Lessons such as being aggressive only on our highest probability setups and not to overexpose our accounts in an already overextended market. I took a step back by referring to the daily chart to see where the secondary level of support was for a bounce and set that zone as a target for a bearish trade with the inverse ETF SOXS. Once my bearish SOX gap trade position was closed, I looked for the next high probability setup to the long side. I saw the market structure holding at this level and repositioned my entry with CCIV on a longer term account. I am still holding positions on the other stocks I have highlighted in this channel in my longer term accounts where I can dollar cost average. However, this account is actively traded with strict stops because I need to keep my account liquid for income purposes. That brings us to current market prices. With the Fed essentially stating they are not concerned with the current rise in bond yields since the return is offset by current inflation, the market seemed to stabilize and reverse on Friday. Nevertheless, the instability in price action seen in the charts recently and overextension well above the long-term channel reflects price levels in need of a healthy correction. In fact, I would welcome a crash or bear market down into the long-term support levels. That would create the greatest opportunity of return on investment. However, as an active trader, not just an investor, I am currently focused on next week's price action. I currently don't see a drastic move to the downside. I think this is unlikely because the Senate just passed the COVID relief plan. The revised legislation now moves back to the House for approval and then to the White House for Biden's signature. The way I am planning my trades are as follows. I mark resistance and support trends on the 90-day 1-hour time frame on SOXX. Then I use the 5-minute chart on SOXL or SOXS to enter trades, ideally on the lower price extreme of the channel, within or near the green parallel lines or buy zones. In my opinion, the highest return trades are in these zones. However, with the COVID relief plan progress and momentum of Friday's bounce, I see the most likely outcome to be a bullish gap up on Monday morning with a run up to new highs. This means a short-term trend reversal, maybe something like this. For this reason, I will be watching the pre-market for price movement and a pullback for a long entry. Currently, the trend is to the downside and could continue lower. If current support breaks, I will switch my bias to the short side for the next leg down. I hope that gives you some insight on the trading opportunities I look to capitalize on. Remember, this is only my personal opinion. Ultimately, we are all accountable for our own actions. Manage your risk as you see fit. As always, I wish you the best in your trading. That completes this video. If you found this video helpful, please smash that like button. Subscribe if you haven't already and select the notifications bell. Thanks for watching.